Hello, Endersword here again. I wanted to do a very popular topic, but unusual topic for me online, but actually very common topic in my real life, which is to cover the GME thing. Everyone and their dog is talking about this, doing something about it. AOC is on stream right now. Tons of people are chiming in with things all over the news. So I will briefly cover the main thing, and then I wanted to try and touch on a point or two that I don't think really other things are talking about that may explain why some of the parties are doing what they're doing, and just some of the things involved in it. So I'll go very quickly, hopefully, over the original premise of the thing. So the whole idea is this is what's called a short squeeze. A company or many companies look at a company like GameStop and they say, well, they used to sell video games, but I went in there last week and they don't have any PS5s, they don't have any Xboxes, but they were selling 80,000 Funko Pop dolls, just wall to wall with that shit. If controllers didn't exist, GameStop would already be bankrupt. So they look at that and say, I not only want nothing to do with buying this stock, I am so certain that this is going down that I want to sell this stock even though I don't own it. So what they do is borrow some shares from other people, and this is the key, that you're supposed to borrow or do what's called a locate to get shares that were owned by someone else. You borrow them and you can turn around and sell them on the market. If that person wants to sell their shares or they move, then you have to find somewhere else to borrow them from and somewhere else to borrow them from. What seems to have happened in this case is that you either had chain borrowing or you had synthetic longs where someone appeared to have a long position, but they kind of didn't have a long position. So what you ended up having happen was that more of it was shorted than even existed in the first place. So they were borrowing 140% of a thing that there was only 100% of. So either they were doing these chain borrows, synthetic borrows, or some of them were just plain not disclosing or lying about where they were getting their borrowed position from. And unfortunately, that does happen. And I think this is shining a big light on why that system may be broken. And you can probably expect some regulation on that. So ultimately, what you're doing there is you're saying, I think GameStop trading at 30 is too high, and I think that this thing is going to go down. So I want to bet on it dropping. So you borrow shares, you sell a bunch of shares, you get $30 a share. That's lovely, and you hope it goes down and you can buy it back cheaper. What you have to do when you do this is put up 30% of this original value. So you get the 30 from the sale of the thing, and you have to put up an additional 30% of that original value. And this $9 is yours. That's your original amount invested in everything. Is you only had to put up $9 of your own money, and you get to sell $30 worth of the stock. So this is lovely. If it goes down, you just kind of make a bunch of profit. If, however, it is going to go up and it doubles against you, then not only have you essentially on paper lost this $30, in practice, the margin that you have to put up, which is 130%, is now going to be based on this new number. So you got the 30, which you never put up in the first place. You had the 9 you put up, but now all of a sudden, I actually have to have $78 there. So this doesn't just mean I have to add an additional 30. It means I have to add an additional 39, and I only put up 9. So instead of it being like double the money or double the difference, it's actually multiple times that. It's like more than 4 times the difference that I have to put up. So I put up 9, and now I need to cough up an extra $39, which is basically 4 times as much. So very quickly, this can end up getting completely out of hand for you, and you end up needing to put up more and more against it until basically you've got $9 up and you need to get up to an additional 126 or something, and it just starts to get out of control. This thing has only multiplied by 4, but the amount of money that you had to put up has multiplied by like 12 or more. So it becomes a compounding thing that ends up going wrong. So the short positions want to stay in this position. They know and think that it's going to come back down if they can only outlast this crazy horde of people. So they keep adding more money in to keep being able to hold their position. But as this goes up and up and up until it was like over 400, then all of a sudden a even small position here, say that you only put up $1 billion to begin with, only for a hedge fund, then at the end of this, you're going to owe like $30 billion just to maintain your position, just to try and stay in it. And so it's kind of at this last step that some of the hedge funds either had to go bankrupt or had to get bailed out or had to close the position. And that's ultimately what happened here, that they couldn't do it anymore and they had to bail out of it. So the whole idea is that by buying up a whole lot, you force things to cover, you force them to put in more money until they just ran out of money. And you got such good leverage on how much you had to put in to raise the price versus how much they had to pay to maintain it every time the price got raised. It was kind of a disproportionate attack, basically, because they were in such a bad position. Now, to cover a thing that I haven't really heard people mention is the sheer arrogance of doing this without buying insurance. So what you can do, and if you're a retail investor, I would essentially never enter into anything without doing something similar to this. So a hedge fund wanted to sell all these shares, and they just sold them. And they did something called naked shorting, where they just sold it and there was no backup plan. They just figured, if I have to, I'll buy them back later at whatever the price is, but there's no backup plan to this. What they can do, however, is buy a call on a position. So they sell it at 30 and then they buy a call at $50. So a call is buying the right to be able to buy the stock at a set price up until a set date. So let's say that they did this in November and then they wanted to buy a call that guaranteed them the ability to sell it, to buy it at $50 up until April, let's say. They would probably only have, before this whole thing started, probably only paid like $1 or $2 for the right to do this. And then they would have been completely limited in loss by the difference between these two numbers plus the little insurance premium that they paid to do this. And the price for those is called a premium. So basically for a couple bucks, they could have completely safeguarded themselves against this disaster. And even when they saw the disaster start to happen, they basically refused to take these positions. And the longer they waited, the more and more expensive that insurance would have gotten, to the point that it wouldn't have helped them in the first place. So basically it was almost like arrogance that they saw an army storming the gate and they just didn't want to spring for a new gate lock. They just thought, well, this army is just a bunch of rabble-rousers and I can arrogantly defeat them anyway, and so I'm not going to spend even a little bit extra to safeguard myself. And then the result of that was essentially complete doom there. So now I want to get to the part that people are super upset about today, which is Robinhood and the other brokerages that were blocking trades today, that were basically not letting people buy in. And of course, everyone assumed right away that, of course, the reason that they were doing this was absolutely conspiratorial. It was just sheer evil. They are controlled by, other brokerages and Wall Street and the Flat Earth Society and like whatever, and they're just Satan himself. And these are just pure evil people. I'm going to establish that that's kind of true, but it's not cooperatively evil. I think that it is independently self-interested type of evil and kind of a screw you customer sort of thing. But I don't think that it's ultimately like the super conspiracy where someone told them to do this. I think you'll see that it was completely in their own self-interest for all the brokers to do it. So what happens is you've got to understand what the Robinhood business model is. There's no commission that Robinhood charges. So if this is you, then you place your trade at Robinhood, and that's about as far as you know. that you're going to get your trade filled or whatever, and you're not going to pay any commission. As far as you're kind of concerned, Robinhood is this free magic thing, and he steals from the rich and wears a hat and whatever. So this looks great to you. You don't seem to pay anything for it. In reality, of course, Robinhood has to get paid by someone, and so it is getting paid by various market makers and other funds out there that are buying your order flow, and they're paying Robinhood for your order flow. So it is called literally pay for order flow, payment for order flow. So basically, they take your trade, and instead of charging you commission, they route the trade to these other parties over here, and then those parties pay them for the privilege to do that. And what these parties end up doing is acting as a market maker or a trade matcher, and they end up taking small bits of each trade that goes in. So they match you with another side, or they act as the other side temporarily. And so if you're buying something, they sell it. If you're selling something, they buy it, and they take that little bit of a difference between the bid and the ask, and that's their profit. So instead of you paying a commission, you're just kind of losing a tiny chunk to them. As the participant, you may not even notice this, but you're going to get like potentially a cent or two worse than if this went to a broader market or if Robinhood handled it themselves. So they're basically just routing it this way. Now, it's not super nefarious. There are kind of perverse incentives here, which of course was the problem. And the overall thing that I don't think a lot of people know, this whole system of payment was literally pioneered by Bernie Madoff. So he's kind of the one that I don't think he outright invented it, but he's kind of the one that popularized this whole thing. And so that should be a red flag right there. Even though that wasn't necessarily connected to his Ponzi scheme, it kind of was philosophically, because it's a little bit of a dishonest way to do things, because you're actually creating a cost, but it's a very hidden cost. You say no commission, but in reality, you're paying a tiny bit more, and maybe you're getting a slightly less good fill or whatever. So that's basically their structure. The thing that people were pointing to as the super conspiratorial thing is that one of these parties that pays for that is called Citadel. And Citadel also invested in one of the failing companies up here that was called Melvin. So in the middle of this whole thing, Citadel, they use the term bailed out in a lot of the news. It wasn't so much a bailout as they just bought something. It wasn't like they gave it out of the goodness of their heart. It's kind of like if you find someone dying of thirst in the desert and you bail them out by charging $50 for a bottle of water. That's essentially what they did. So they took advantage of them, but it does mean that they had a financial interest in them after this point. So it wasn't out of the kindness of their heart at all, but it does mean that they now had a financial interest in that short position and the survival of that company. So there is an innate conflict of interest in that they're buying some of the Robinhood order flow, and they have an interest in potentially suppressing some of that order flow. What doesn't make sense is why Robinhood would give a fuck. So even though they're a customer and they are paying for some of this, they're not paying so much that anyone at Robinhood would look at it and say, you know what, we should destroy our entire business model just so I can keep one of my multiple customers on this side happy for like 2 days. So it really doesn't make sense for Robinhood to agree to this. There is some pressure there. Like there definitely would be some influence. Both of them deny that they've talked about it or that there was any influence. You can believe that if you like. It may be true, it may not be. I ultimately think whether they attempted to influence them or not, there wasn't enough influence there for Robinhood to agree to it. And this whole idea that everyone in Wall Street just likes each other and so they're going to cooperate or something, they're really not. There are cases where stuff like that happens, where there's like collusion. Usually they're at each other's throats. That's the whole point. You're trying to make money off the other guy, not the other way around. So there's really not a lot of reason that Robinhood would cooperate. So why did Robinhood do what they did and all the other because this also only really applies to them, and it wouldn't really apply to the other brokerages that have no such relationship and have been around for a long time and do their own model and whatever. So it doesn't make sense that this method would apply to everyone, even if it applies to one. So why do they want to halt the trading? And I think it is more because of margin. So again, we talked about margin up here for shorting, but margin also applies on the long side. And the reality is that Robinhood had a bunch of YOLOers coming into this. So tons of retail investors, but just also a ton of people that are just fucking batshit crazy. And we're going to press this to the end of the earth. So some people came in with a nice limit. They're like, I got $500, $5,000, whatever. I'm going to take part in this thing in like a pretty rational way, and I'm going to invest what I want to invest, and that's it. There's other people that would come in and basically take advantage of the margin, meaning that they're borrowing to be able to invest. So if somebody comes in and deposits $3,000, then with that $3,000, keeping 30% of it, they can actually buy $10,000 worth of stock. So let's say they come in and buy the $10,000 worth of stock at $30, or let's make it easier. Let's say $20 each. So the stock was trading at $20, and instead of buying $3,000 worth, they can buy the 10K worth, and they end up with 500 shares. But out of this, $7,000 to buy these shares is borrowed. So they actually just borrowed the money to do it. Now this $20 goes up a lot, and it did very quickly. Let's say that it goes up quickly to $80. Now they have 500 shares times the 80, which is now $40,000 in equity, or $40,000 in value. Their equity is now that $40,000 minus the $7,000 they owe back, which means they now have $33,000 in actual equity that they can now borrow against. So instead of their original 3 that was able to borrow 7, they now have 33 that was able to borrow 77. So they're now going to buy more at the $80. And so now they're up to $100,000 worth of the stock. I'm great at zeros. And that goes up again. And now it goes up to like $200. Now they can look at their equity again and say, okay, instead of $100,000 worth, I now have $250,000 worth. I'm going to borrow against the new $250,000 and buy even more shares. And now all I ever gave you was $3,000. So now the company is lending you close to $250,000, and you gave them $3,000 like last week. So the concern that Robinhood has with so many people doing a similar thing, and whether they did it to this extreme or not, some people definitely did, and definitely are currently in this position. Whether they did it to that extreme or not, so many people are doing this that ultimately what happens is that Robinhood's total lending is now like 80%, 90% in one stock. So usually if a brokerage is lending out in margin, they're assuming you're going to buy like whatever. And, 20,000 people are going to buy like 5,000 different things. And some of you are going to buy the same, and some of you are going to do this, that, and whatever. But it's going to spread out. You're going to owe for Apple. He's going to owe for Facebook. He's going to owe for Intel. He would have shorted AMD, whatever it is, right? They balance out, and they're very diverse. This creates a situation where they're not diverse at all. And all of a sudden, Robinhood's looking around being like, so these people from Reddit owe us $4 billion, and it's all on this one stock, maybe 2 of them. They want to go to GameStop and then catch a movie at a closed theater. Does that sound like a good idea? And then the risk people come in and say like, no, that's a horrible idea. How could you possibly be in this position? It's so volatile that if this was to drop from the $200 or $400, we only have a padding of 30%. Well, that means if it dropped from 400 to 200 in 10 minutes, which it did, it dropped from like 490 to 200 or less in 10 minutes when they reopen. if you had exposure to that, you've lost everything. And the people that owe you $250,000, most of them can't pay it. Some maybe can. Maybe there's something you can repossess, but it's a whole process. In a normal situation, they're supposed to be able to say, okay, well, it went down 10% today, which is really bad. And overnight, we call the guy, or we let them know they have to deposit more. And if they don't deposit more, we're going to sell them sometime today and we're going to get our money back. When it moves so quick, they can't possibly do that. They can't actually get under it in time or place these orders in time and figure out what to control and when to pull the trigger and so on. So they're completely exposed. So I think that's why Robinhood ended up halting, and that's certainly why the other firms ended up halting. So it really had, even though it's horrible in the way it looks like Wall Street's like trying to stop you from creating a revolution and YOLO swag Lambo, like whatever the fuck you're talking about. It looks like they're just against you philosophically or something. And this is horrible marketing for them as a company, because they're like so positioned themselves to be the company that would never do such a thing, that wants to, like their whole premise is that you steal from the rich and whatever. So I really don't think that's why, but I think they hit the reality, which was that if they let you do it, they were clearly going to go bankrupt. Like the guy went on, I think CNBC today or whatever it was, and kind of said like, it's not a liquidity problem or, anything. And I don't think it was necessarily a liquidity problem. It was a huge exposure problem. It's what they call concentration risk, where so much of your debt is locked into one thing, one outcome, that you can't possibly safely hold that because you're so tied to one thing. And the funny thing is, particularly with some of the politicians now coming out being like, Robinhood is terrible and why would you ever do this? They literally are doing the thing that we wanted them to do 10 years ago, which is when people did the opposite, and when banks were like, I'm giving out all kinds of mortgages, and every mortgage that I'm giving out as this bank is a house in the western part of Detroit. And then when that crashed, then people were like, why the fuck did you have everything in one place, and why didn't you tell everyone that? Of course, if like the neighborhood goes under, the entire neighborhood goes under, and if one guy defaults, then it's more likely that the next guy is going to default in property values, blah, blah, blah. Why didn't you diversify? So it's the type of thing that we were screaming at people then of like, you can't do that. You can't take that much risk. You have to follow regulations. You have to follow these limits. You have to safeguard yourself. If you go bankrupt, then the problem is all your clients' accounts are now in default too, and the government has to come and bail them out and pay insurance and all this stuff. Well, that's what would have happened here. If Robinhood goes under and they have an account in your name for like $50,000, then a government-run insurance thing kind of has to cover that. Either that, or they step in and bail the actual company out so that they don't go bankrupt, and everyone hates that shit. So it's really doing what this firm was doing in the opposite direction. They were way too exposed short. Robinhood was ending up in a position where, without even owning the damn thing, they were so exposed to the strength of the stock that if the stock failed, then they were going to lose just everything. And that was true in a lot of these other companies as well. So like Webull, and even some of the more established ones like Interactive Brokers did the same thing, where they just felt they were too exposed to it. I guarantee they weren't at like 80-90%, but at a more established like long-term place, if you had one stock exceed 10% of your total portfolio, a normal bank would just freak the fuck out and be like, that's way too much. That's way too much risk in one thing. We got to get out of this. So anyone would have stopped before that, and I think they were almost crazy to let it go that long. What they should have done is, as it started to ramp up, they should have smoothly increased what the margin requirement was and put caps on how much pressing your margin you could do, which is basically this chain of rebuying. So to cap it out based on what your actual original investment was, as opposed to what your equity was. So there are cases where it starts at 30%. They could have basically said, all right, starting tomorrow, it's 50%, and then 70%. They've now halted it completely. They've resumed, but they've now resumed with it at 100%, meaning you have to pay for everything you own. You can't borrow it. A lot of people were asking the question when I brought this up of why then didn't they only do that to margin accounts. I wasn't borrowing it. I was just paying with my own money. So why did they stop me? I think the unfortunate real answer to that is it's a fucking app. You found it on iTunes or something. It's not very good. It has a buy and a sell button. And I think there's treasure chests every now and then, and it rewards you. It's just an app. It's not very sophisticated, and I don't think their system even has a way to do that. That's pure speculation on my part, but it's a rare enough thing that you would even have to do this in the first place, such that I bet they just never thought of it, and that no one took the time to program it in. And it's relatively new. It's like 3 or 4 years old, really, that's been rolling. It's been focused on, they've been more focused on adding support for gold and adding support for Dogecoin and adding this and that I bet they just never built that. And that's not a good excuse, but it's just a byproduct of them being new, and I bet they didn't envision a situation where they'd have to halt it, usually, or selectively halt it. Usually when firms halt stuff, and it's actually very common that things do this, it's just you usually don't hear about it because nobody cares. And what they usually target is like small stocks, like a mining company will start really trading weird, and then they kind of get uncomfortable with that. They don't want to have people lending or borrowing against it, or they think that maybe something illegal is happening, and they just say, you know what, I don't want our clients to deal with that, so I'm just going to shut this down, and they do it. But usually no one cares because it's not like a big story that like millions of people are jumping on. It's just something shady that's happening. They see something that looks like a pump and dump scheme or a fraud or something, and they just be like, nah, we're not going to do that, and so they just turn it off. So it would be rare that they would selectively say, I only want some people in some types of accounts to have this and not other people. So I think it's legitimately just a technical thing, but this is not to excuse Robinhood in general. I think overall this has really exposed, one, what their actual business model is, which is you are the product. If it is free, they are selling you. I think this has exposed that for a few years now. Kind of me playing around in the crypto community when this first came out, a lot of people shouted like Robinhood is clearly not to be trusted. They are holding your coins for you. You can't get them out. There's a lot of technicalities and fine print here. I wouldn't trust this. You know, it's a problem. But a lot of people really, really liked it, and it was so easy and whatever that when you brought it up, you often get shouted down by a lot of people. Unfortunately, as much as it's kind of an I told you so sort of thing, it's a lot of people told you so. So if you were kind of relying on this app, this is why people kept saying, can you go to a real brokerage? Because a real brokerage is not going to do some of this stuff, and or at least they're going to have more systems behind it or something. So, you know, this probably wasn't going to happen at a major bank. This probably wasn't going to happen in a major thing. It's the type of thing that's going to happen in an online brokerage, on an app, on a whatever, that doesn't have the same sort of development and backing that a lot of the things do, let alone the diversification that a lot of things do, because I think that's what you ran into here. So definitely not excusing Robinhood as a total. It's more that I'm saying that they were individually self-interestedly evil, not collectively conspiratorially evil. Usually the thing with evil is 7 evil people will just do evil things of their own volition. They do not need to be told to cooperate. And they very often are very bad at cooperating. So that's kind of what I'm driving at. So take that for what it's worth. Hopefully this covered some stuff that I don't think a lot of the other people were covering. Just that they kind of didn't get in the weeds or may not have this perspective. I kind of used to work in this particular area like 10 years ago, so I kind of know how we would, basically the risk team inside your own brokerage annoys the people that want to sell more things. They constantly want to sell more things or take more risk, and you have to keep them in check basically from doing that. And I think that's kind of what happened here, where internally they were just like, we can't possibly justify taking that much risk. We have to stop. The other thing, just before I'm done, I want to touch on very, very quickly. Let's say that you are not on the YOLO side of this, and let's say that you do think that this is a little bit crazy and that you do think that this is going to come down. And somewhere in your mind is the idea that you're going to short this or that you want to bet on it coming down. Not crazy. Definitely is going to happen, but I can't tell you when. I can't tell you how bad it would get, whatever. So if you short it, you're going to expose yourself to this risk. And now, because things are so volatile, the cost of this insurance I was talking about is just out of this world. You couldn't possibly short something and buy the insurance and make money. It would just be nuts. So what you can do, however, is take the opposite side of this. So if you were looking to get into this on the downside, what you can do is buy puts on it. And now these are still super risky. They're very volatile. It's basically an all or nothing bet. So whatever you put in, you either lose it all or you make money off of it. So always know what you're getting into. But the real key to it is a lot of people are trying to play these really short-term ones because they're more leveraged. So they're buying puts and calls for like January, and it's January 28th. So they're really, really cutting it tight, or buying ones for like early February. If you're going to do it, calm down, take a breath, buy puts for like May. And you're going to pay more money to do that. You're going to pay more of a premium to do that. But if you really think that this is kind of overwrought and clearly this isn't going to last, and GameStop is damn near bankruptcy, let alone worth $40 billion, and you know that rationally, and even a lot of people that are in this, they know that this is good mechanically, but they don't really believe in the company or anything. They just are viewing it as a prop to make this stuff happen. So take a breath, go longer, go farther out, pay a little more for it, but it's kind of a safer way to make the bet on it dropping as opposed to kind of putting all your eggs in like a short-term thing. It's really one of those cases where a lot of people think a lot more will happen soon and that a lot less will happen later. It's people use the expression that people overestimate what will happen in 2 years, but underestimate what will happen in 10 years. And with stocks, it's kind of like people keep thinking like this news came out, something's going to happen like tomorrow or like this week or something. But then they often underestimate how much will change in like 4 months. So if you think that something's going to drop, just go long, just relax, like go long term, not long, but buy a put longer term, pay the premium for it. That's the safer way to address it. Do not get caught in this trap where you short it at even like $300, but then one day it shoots up to 500 and you're like, do I get out of it? And I have to put more money in, like whatever. Don't trap yourself with that. So just a warning. And if you're in it, of course, have fun. This has been totally fun to watch and see. And I love I didn't even get into derivative math, but I love that stuff. And some of the derivative math is like crazy. This is the highest implied volatility I've ever seen. It's nuts, but if you're in this, have fun. Don't lose your house. Don't lose more than you can afford to lose. If you get to a point where the money is like life-changing, take it, stuff like that. So overall, here you go. Not so much meant as financial advice, but a little bit of mechanical explanation. Thanks for watching my paint sheet.